All traders do trade better together. Your Trading Nation team today, Jonathan Krinsky, technician with MKM Partners, Max Wolff with Manhattan Venture Partners. Jonathan, the S&P 500 hasn't hit a 52-week high in nearly 52 weeks. Cause for concern?
Not yet, Brian. And it's interesting. We've seen this ongoing kind of rolling bear market. It started with the energy materials industrials in late 2014. We saw it in healthcare, biotech, and now we're seeing it in retail. So as these kind of sectors have gone through these kind of mini bear markets, the overall market has just traded sideways. And as you mentioned, we haven't hit a new 52-week high since last May, and that's pretty unusual. In fact, in the last 50 years, there's only been 11 times where we've gone this long without hitting a new 52-week high. What's interesting, though, is once you actually do make a new high, after such a long period of consolidation, the forward returns are very bullish. They've actually been up 1 year later every single time for an average 16% return. But that doesn't necessarily get us ready to play the hero card and anticipate that breakout yet. We still have a lot of issues you're seeing with the department stores and the retailers today, European banks. So rather than anticipating and looking for that big breakout, we'd rather wait for confirmation, get a new 52-week high, and then we can start talking about that. And if we look back, the last time we went this long without a new high that wasn't within a bear market was 1994-95. I think we have a chart there. And you can see kind of a similar pattern. Went about a year, consolidated, and then once you got that breakout, there was plenty of runway to the upside. So we'd rather be a bit patient, let the market kind of show its hand, and then jump aboard here.
Okay, Max Wolff, your view on what the market is doing right now, and more importantly, what we're likely to do.
Yeah, so we see it a little bit differently. In our mind, what we're seeing in the markets here is that there's selective strength. We look like we're in a bit of a topping pattern. We had a long explosion to the upside here, partly as money ran from all over the rest of the world into the relative safety and appeal of U.S. equity markets, which we thought got a little bit out in front of their skis, a little bit of the cleanest dirty shirt in the hamper factor. And we've seen rotating weakness as well as rotating strength in the most recent 2 earnings seasons, really pronounced in the most recent one. If you did well, you blew out to the upside, but for a lot of folks, they didn't do well. They didn't blow out to the upside. Overall, indexes are going to underperform, we think, for the next 6 to 18 months, with some select names being strong. In tech, where we cover most closely, we see this really strong. So you see things like Amazon breaking out to the highs and things like Apple dragging down the indexes, which are in some cases capital weighted. So select areas of massive strength on the winner names. Otherwise, a lot of pressure on things that are still at an 18 multiple and that are a little bit overbought by a global and historical standard, in our opinion, on a relative value basis.
Okay, Max and Jonathan, we appreciate it. Thank you guys very much. By the way, speaking of weakness, stocks are weak right now. The Dow down 185